Welcome back to the Own It podcast. My name's Dion, and I just wanted to jump in before we started today's episode. I have David, he's a mortgage broker on, and we're really excited. We're actually going to split this episode into two parts, but it is important we jump in at the start and just put a disclaimer that the information provided in this podcast is for informational and entertainment purposes only and should not be considered as financial, legal, or investment advice. Welcome back to the Own It podcast. My name's Dion. We're here to discuss all things property. This is actually part two of us discussing finance. In the previous part, we spoke about a lot of the foundations, some mistakes people make, and this is just a continuation of that. So jump and listen into the first episode before you come to this one. David, welcome back.
Thank you.
Mate, it's been a week since we last spoke. Yeah?
I know, but I haven't moved.
Yeah,
I've been on the couch this whole time.
We were just chatting before we started recording this podcast, and we were chatting about, because I had a question like myself, something that I find.
Yep.
And this, I think, is the whole point of the podcast. And when I get guests on, it's great because I want to represent the audience. Obviously, I'm an industry professional, but everyone's still learning all the time. The question I had, if someone goes around, like they sit there and go, I can do what a mortgage broker does myself. I can go shop. I say, you're already smiling. Yeah. I can go shop all the banks. And I heard it from, quite often from people like, hey, if you go do that, it can impact your credit score. Is that you were saying that's
yeah. No, it's no good. It's like getting multiple credit cards. It's like point hacking, right? If you listen to the last episode, it's like point hacking, right? If you're going in and constantly getting different inquiries for the same facility, at some point the bank's going to say, what are you doing? Like, hold on, why is this person doing it? And there's been times where, these things can all be mitigated, right? It's not like you've destroyed your credit score or you destroyed your chances of getting a loan. It's not that at all.
Yeah.
All of these things need to be explained, right? That's where a broker will come in, look at your credit score and say, hey, what are all of these? Why do you have these here? What are we doing? They'll come to me. I'll then decide what information we pass on to the lender because I know what's important and I know what part of that information they want to hear and need to hear and what part's going to be too much information.
Yeah. You're pretty much just explaining, like you're looking at the finances and then giving the explanation to everything.
Yep.
Yeah. I wanted to do a case study, and I know like we again spoke about this before recording, like we have to preface that not every person's financial situation is the same. In fact, everyone's is different. And as we already spoke about again on part one, 10 different people could go to the same bank and get different capacity, different rates. So it's so important when we chat about like a case study, which we want to sec, that just because you might be earning a similar amount doesn't necessarily mean you'll be able to get this amount or interest rate or whatever. But, really typical client of mine, for example, young couple, both of them on average income, let's say $75,000 a year.
Yep.
They're probably renting an apartment, let's say $450 a week. I'd say that's probably, 2-bed apartment in the city. They go, hey, look, we've been saving some time. We might try tap into one of these government initiatives, right?
Yep.
And we can chat a little bit about that as well in today's episode.
Yep.
They got $35,000 in saving, $75,000 each a year, give or take. Like what is their capacity potentially going to look like? What's the interest rate they might be able to get?
Okay. So
you've done a little bit of homework on this.
I got the laptop out. Lots to touch on here because as you were speaking then, right, you give the whole sort of map out of the financial situation of our mythical clients. But like you said, they were renting at the moment.
Yeah.
Important, but not really, right? The savings though is of $35,000. How did they get the savings, right? If we're going to go into these government schemes, we need to know how these savings came about. Was it a gift? Did they just get married and they got gifted, $35,000 worth of cash gifts from family? Is that what it is? Or have they genuinely saved it up? But if they have been renting, then there's other things we can use to get that as well. But looking at just income, right?
So and 75 a year, just income, 2 people.
Everyone's got a HECS debt these days, so you got to put on a HECS debt. Even I've got a HECS debt.
Not me. I might be one of the only ones that don't. No.
Mate. Smart man.
Straight into real estate.
Smart man. So look, 2 things with this, right? $35,000 in savings in Victoria. You're getting yourself on the first home guarantee, the government scheme. You're getting in at a $600,000 property. Yeah. Right? You can easily lend the money for that. You need $570,000. The borrowing capacity here, if you've just got your HECS debts, borrowing for that $600,000 property, average wages of $75,000 each, no credit cards.
Yep.
Your borrowing capacity will range anywhere from in the 700s, the bank will lend you, right? But you can't get the 700 because you don't have the security to match it up there. You've got the $35,000 And that's going to allow you to buy something worth 600,000. So you have an oversupply of income in this scenario, right? And that's where it's really important to know that you don't get a loan just because you've got a heap of security, right? If you've got a parental guarantee, amazing. But if you don't have a job, you're not going to get a loan. But if you've got a really high paying job, but absolutely no savings or any security to put towards to the bank, well, you're still at risk.
Because I think so many people go and they just have this mindset, right? And when I was younger, I think I did as well, and I'm sure you'd agree. You go, oh, if you could save $50,000, the bank will just give you the other $450,000, to purchase a $500,000 place, like 10% deposit. The bank will just give me. It's like that's not true. No. You could have a really bad income, and as you said, like if that $50,000 is gifted to you, there's no proof you can service a loan. They will not give you that money.
Yeah,
and it's like even on this, as you said, like mythical clients of ours that we're discussing, if that $35,000 was earned or it was gifted and everything else is the exact same on this client, all the other points of criteria are the exact same, it's still going to be it's going to be a different rate, different, everything will be different. And that's why it's like we can't just give, examples sometimes.
Well, that's when it comes down to, exactly, that's why you can't give an example because everything's so different. But with the savings part of it, right, that's something that they call genuine savings, right? Genuine savings is funds that have been saved in your bank account over a period of at least 3 months.
Yep.
That shows that you have consistently been able to put that money away. It shows the bank that you are responsible with your money, right? In this case, for mythical clients A and B, if they were gifted the 35 grand, but they've been renting, no problem. If you can show a rental ledger from your property manager that you're renting with to show that you are consistently making your repayments, that is like a savings account, or that will represent genuine savings for the bank.
This is because it's proof that you can.
It's proof that you were responsible.
Yep. So one thing you spoke about is like government grants, and that obviously is going to play a massive part for a lot of first home. And in fact, like, so my side of things, and we're not here to talk about me as a buyer's agent, but obviously I work with a lot of buyers. It's becoming more and more common. I would say 70% of my first home buyers are on some sort of government scheme. And all clients, right, first home buyers, if it's going to be a principal place of residence, they can purchase it for sub 600,000. They can get, they can potentially, potentially waive stamp duty as well. So there's always like government schemes when you're a first home buyer, we're trying to, maximize it. If you're a first home buyer out there, what government schemes can you potentially tap into? What does that mean for you?
First thing I'll say is the first home owners grant. Don't listen to your parents. You can't get it unless you're building new. Unless the property is brand new, you're not getting 10 grand. The rules are changed, and they didn't do a good job of telling everyone the rules changed. And everyone that comes in to buy their first house is like, oh, my parents said I get a $10,000 grant. It's only for new builds. Right? So sorry to burst your bubble on that one.
So let's just discuss that for a second. That might be house land package. That could be, is it like an off-the-plan
apartment?
I will jump in here. We haven't spoken about off-the-plan apartments yet on this podcast or off-the-plan anything. I just have to put in here, highly risky, do your own due diligence. And I'm sure you'd agree with this, don't just buy a property so you can capitalize on the schemes if it's a bad buy. Like so many people focus on saving $10,000 that they cost themselves $50,000 by buying a bad property. And obviously we can't, discuss that today. We don't have the time. And also we can't give financial advice, but just be really mindful when it comes to off the plan apartments. So there's that $10,000 government incentive for brand new builds.
So brand new builds, right? And you know what? I'll segue with a story because it's really, I know we can't give it, we obviously don't want to give advice, but I'll talk about my own personal story, right? When I purchased my first house, I was building new. So I was getting the $10,000 from the government, but I was building in COVID, right? So when the home builder grant was around, that $25,000, I got that as well. One thing I didn't know was the first home guarantee, which was also around. So I could get in with a 5% deposit. I had at that time, I think for what I purchased was a 12% deposit, if I'm remembering right. But my broker at the time, love him, by the way, very good friend of mine, we didn't discuss the first home guarantee at all, right? I ended up paying lender's mortgage insurance, which was probably a $9,000 cost I probably didn't need to pay.
Let's jump into that as well in a second on what LMI is.
So that just shows there are so many things that you can pull, right? So because I'd bought a block of land, no stamp duty, right? That was 20 grand saved there. Then I had the home builder grant, that was $25,000 up to 45. And then I had the first home owners grants, another 10, right? So it was $55,000 worth of value. I don't mind that I paid lender's mortgage insurance of 9 grand. I got 55 back. So
if you know, look at it, it's a balancing act, isn't it? Some buyers are so scared to spend over $600,000 to pay stamp duty that they buy something that's subpar. to, again, save
save a little bit.
$10,000 or $15,000.
Yep.
When if they just push a little bit more, yes, it's going to hurt now. And I'm very aware that like, $10,000, $15,000 is a lot of money, right? But what is, even more is buying something that is going to cost them $30,000 in the long run.
Yep.
Yeah. So it's a juggling act, right?
100%.
Yep.
So the first home guarantee is probably the best government scheme that's around, which is where you can get if anyone knows what a parental guarantee loan is, where your parents guarantee your home purchase, this is the same thing, but the government backs up the purchase.
Well, let's jump into LMI. Let's jump into guarantors as well, because they're, again, something else. If the government's not guaranteeing a loan for a client, often the parents are involved or there's some sort of gift as well. Let's jump into both of those. So what's a parental guarantor loan? Like explain that.
Yeah. So parental guarantees, like I said before, when you get for your home loan, you've got income and security, right? Security can come in a few forms, right? Cash come in forms of another property that you own, or it can come in the form of a government guarantee or your parents' house, right? So if we paint some really easy numbers, right? You're buying a house for $1 million and you need a 20% deposit to not pay lender's mortgage insurance. So that means you need 200 grand. Let's forget costs. It's just easier for numbers. You need 200 grand. You've only got 100 saved up. Your parents have a fully paid off $3 million house. I will say this though, it could have a mortgage on it. That's okay within some limits, obviously. And they don't even need to be working as well, your parents, right? There's banks out there that will do retired parents as well, which is fine. Now, essentially what will happen is there'll be a limited guarantee put on the parent's property of that further $100,000 to give the bank that's taking you on the full 20% security. However, that 100 grand that's secured against your parents' house, you still need to borrow that money.
Yep.
So it's not free money. The bank's not just going to put up and be like, we're cool when you sell it, like let me know, we'll take it back later. Yep. You still need to borrow the money out, so you still need the serviceability, and that's all there.
It's security for the bank though, right?
Exactly, right? The bank needs to hold something. And that's why the government came in and said, well, not everyone's parents can or are willing to do this for them.
Yep.
So the government now does that. You can get in with a 5% deposit. They'll guarantee the further 15%. You still need to borrow it, of course, but you don't pay lender's mortgage insurance.
Okay.
We're just saving you depending on how much you purchase for, 25 to 5 grand.
So lender's mortgage insurance, it put simply is...
Lender's mortgage insurance is a insurance premium that protects the bank, not you, right? Protects the bank in case you default. So if Dion doesn't pay his home loan off, the bank's going to say, hold on, insurance company, come and help us out because we couldn't sell Dion's house for what he bought it for, right? And I will stress though, lender's mortgage insurance is just sometimes a part of business, right? It's not a bad cost. If you use it right, it can really save you a lot of time, right? If you get a purchase with lender's mortgage insurance, right, I would say a 12% deposit is really handy, because that's where the premiums are at a much lower rate and it's not going to be super high. But if you go up to the 95% range and you need to pay lender's mortgage insurance, all of a sudden you got a 25, 30 grand bill.
Well, I think as well, and we cannot give financial advice, disclaimer, and I'm going to probably put a disclaimer at the start of this video too. But like I see or hear so many people talking about like, oh, I'm going to save a 20% deposit to avoid paying LMI, right?
Yeah.
And they spend maybe 3-4 years saving up to get from 10% to 20%.
Yep.
In that time, the market's moved so much that it's like the opportunity cost. It's like now instead of buying in at 700,000, they're going to have to buy in at 900,000. And they did this to avoid paying, a LMI fee, which could be $10,000, $20,000, which is built into the mortgage over the period. That's another important.
I mean, if they did this 2-3 years ago, it'd be okay. Market hasn't really moved much in Melbourne, so we've been okay. But if you're doing it now, you got a problem.
Yeah.
But I hear it all the time. It's like, oh, I just want to save up a little bit more. You'll never outsave good capital growth. You'll never outsave them.
Yeah. And I think as well, touching on what you said about the government stepping in and going like, hey, not everyone's parents can go guarantor. I think it's a really good thing. I think it's very topical talking about like affordability, getting into property. And it is like, I think everyone can agree that it is the hardest it's ever been and it is only going to get harder.
Yep.
So I'm glad that there are some initiatives out there that can, help somewhat even the playing field. It's never going to be completely fair, but I think at least it gives the opportunity for some people out there that don't have parents that potentially have a house that's paid off completely or it's still hardly leveraged. It still gives them a chance to jump into the market, or it gives them the independence as well, because that's the other thing. Some people don't want help from their parents and they don't want to put their parents, they feel guilty, like putting their parents in a position where, they have to guarantee their loan. They don't want to put them in that position that they go, hey, I can go to the government and get a scheme as well. Yep.
100%. And I think what's really important is that although, like you said, it is the hardest it's probably been to buy a house now. It also at the same time has never been easier.
Yeah, true.
If you're really tuned in to what's available to you, you can get in no problem. Yeah, it's hard. I get it, right? You got to sacrifice a lot, like our parents would have when they bought property. But if you sacrifice the right things at the right time and use the right pathways in, you'll be able to get into your first home no problem.
Yeah.
I mean, a two-income household of average income of $75,000 each are borrowing $700,000.
Yeah.
If you can save up some money there, no worries. And if you're lucky enough to have parents guarantee, you can get something really good. I've got a young couple at the moment looking to buy their first home worth $840,000. They have regular jobs.
Yeah.
Right? They're just smart with their money. There's no credit cards. They paid off their HECS debts early because they know that's going to affect them. HECS is another big one, right?
And let's jump into that too. That's something I've got noted down. That is so topical.
Yeah.
I'm going to clip this as well for a social media
Yeah.
because I know it's super topical. How much does your HECS impact when you go to buy a property? Like, what does that look like? What's the average person, or what's the average impact of HECS debt on a buyer?
It depends on your income, right? So we don't pay HECS until we're earning over, I think it's 55 grand a year, something like that. If you're earning underneath 55 grand a year, let's say for argument's sake, Dion, you earn 40 grand a year and got a massive HECS debt.
Yep.
But your wife, she earns 300 grand.
Yep.
Amazing. We're not expensing out your HECS debt because you don't technically need to pay it.
Yep.
Right? It's all based on your income. As your income goes up, we need to expense out that payment.
Yep.
And it doesn't matter if your HECS debt is 200 grand or 5 grand.
Well, this is the other thing, right? There's a misconception that if I pay down my HECS debt half, that's going to help. It's like, no, that doesn't actually help at all. It's all based on serviceability. So you could have I know it's not going to exist. You could have a $1 million HECS debt. You could have a $10,000 HECS debt. If you're earning the same amount of money,
you're paying the same repayment.
The same repayment as well. So I think that's important. It's like, hey, you have to factor in paying off your whole HECS debt or none of it. It's like, don't go halfway. That's worst case scenario.
Yeah, literally going halfway is just going to be the worst possible situation for you.
You're giving up cash you have in your pocket and there's no benefit to it. Yeah,
exactly. So it gets to a point where I think it usually tips over, if I'm remembering this right, at about the $80,000 a year income mark, you start seeing real big benefits in paying your HECS debt off.
Yeah.
You can usually outborrow the HECS debt money. Right. So I had a situation for a client that wanted to buy something and we needed to bump up the servicing a little bit. They were already paying lender's mortgage insurance. But when we did the sums, we paid off the HECS debt. The LMI premium went up only $1,500 and their borrowing went up 60 grand.
Yeah.
And the HECS debt was 10.
Yeah.
Right. So you get a lot of extra income. So you get a lot of extra serviceability to buy the property.
Yeah.
If you just work it out smartly.
Yeah.
It doesn't work for everyone, obviously, but that's why HECS, you need to think about it in a different way. It's not like a general debt where you'll get, if you pay down your car loan to half, your repayments will halve.
Yeah.
Well, no, as you earn more, you're paying more.
Correct.
So it's going to affect you as your income goes up. And that's when you need to really think about these strategies.
It's really unique. Yeah. I think it's really topical. More people, more than ever, are going to have this conversation when it comes time to, buying a house.
So
how does my HECS impact this purchase? So it's really good for people to kind of get that understanding, like, hey, I'm 3 months out from buying a property. I've got this HECS. Like, hey, before you pay that HECS off, you should assess, and as we spoke about before, it's like, it's about balancing everything, right?
Yep.
Like there's not one size that fits all, when it comes to this. There's so many different avenues that you can go down. It's like you should speak to a mortgage broker first before you start, I guess, taking any control of your finances. And work. Like, speak to a financial advisor, speak to someone that can help, right? It's so important to say that.
Well, that's like when someone comes in to see us before they go purchase a property, that's why we get so much information up front, right? We get it all. We paint the entire picture so we can look at all these scenarios for you.
Yeah. I'm going to ask you 2 questions.
Yep.
What's your best client look like and what's your worst client look like? Obviously not appearances, right?
Yeah.
We're talking about finance-wise, like, what's good, what's bad. Again, a lot of people listening to this will be first-home buyers, learning about buying a property and getting to that stage where they might even be looking.
Yep.
What are things that they can do or be aware of, right? What's worst and best client look like?
The worst client's the one that's looking for the cheapest rate, first of all.
Is that common? Is that all the
No,
time?
it's not super common anymore, really. People are coming in trusting the professional, right? And they'll ask, hey, I've seen this bank, offer XYZ rate. What can we do about that? And I'll explain why we either can't achieve that rate or they've misread.
Yeah.
Right? And they'll trust the professional's opinion there, which is great.
And do you think that's changed over time, right? Because at first, maybe when mortgage brokers became more and more popular, people are like, oh, I can just use them to get me the cheapest rate.
Yeah.
And then whereas now it's like, I think it's like 90 or 95% of people use mortgage brokers, right?
I wish it was that high. We're at I think it's at 80% now,
Okay.
around about that. But yeah, it's still a massive market share,
Massive
right?
market. And they see the value. It's like, hey, as you said in the previous episode, like, hey, you're just the guy that does the paperwork, right?
Yeah.
You make their life easy and it's no additional charge. Like it just makes sense.
Yep.
So I think that mindset has shifted, and that's probably why that's not as common. Like people are like, hey, Dave, just give me the cheapest rate possible.
Yeah. I
Because
mean,
it's like, you know,
it's hard when people want to rate shop because that's when it makes it really difficult because they start pigeonholing themselves to certain lenders. That might not suit them.
Well, that's exactly, they're trying to reverse engineer it, right?
Yeah. They're trying to get the rate, but then you don't have all the front end stuff that you need to get that. You don't have the 40% equity.
Yeah.
You don't have a high paying job.
Yeah.
You know what I mean? You're average income earner and you're a first home buyer that wants to get into a property. This is what we can achieve.
Yeah.
But the best client though,
Yeah.
right? Best client's gonna be the one that trusts you first of all. And you would probably be one of your best clients, someone that just trusts your opinion on something, trust your guidance. And also, I always say it every time I talk to a client on the phone, ask them about personal debts, short-term debts. And they say, no car loans, no nothing like that. That's the best type of client.
Yeah.
They've taken out responsible debt or they're looking to take out only responsible debt.
Yeah.
Right. And someone if they've got a credit card, I don't mind a credit card, right? As long as you understand how your credit card's going to affect you, right? Do you know how much you got a credit card limit at the moment?
I actually don't have any credit card limits at the moment.
What was your last credit card limit?
It was probably like a fair bit, to be honest.
What,
Like it would've
15
been-
grand?
15, yeah.
So like a $15,000
By the way, I just want
limit.
to say, I'm fully aware that 15 grand is not my money. It's
mate.
it's no flex, right? I don't own that money.
15
it was
grand.
only to get a good card. I have to preface that. It was only to get a good deal on
That's what I mean. So the good deals have the higher credit limits, right? Same issue.
Yeah.
A $15,000 credit limit will cost you 75 grand in borrowing capacity.
Crazy. That's
75 grand.
That's nuts. And it actually scared me.
Yeah.
Like it scares me because like I'd say I'm very conservative with like how I'm like that actually scares me.
Yeah.
Like
it's a wild amount of money. Just to have access to 15 grand like that, I think we shouldn't be able to do that.
yeah.
Right. Unless you have a real reason to have access to 15 grand at a time.
Yeah.
You don't need that.
Don't do what I did.
Like $2,000 credit card limits, but the banks don't even offer it. It's not even your fault though.
Yeah, well,
the banks don't offer it.
This is the craziest thing, right? And this is again, we're jumping into like financial, personal finance, but it's just what we're talking about, may as well. It's so crazy that it's like when you get a credit card, they want to give you like, because that was the minimum too.
Yep.
It's like
they want to give you more.
They want to give you money. They want to get you in debt. It's
scary.
It's scary. Like I know we're not talking about this, but
whoa, that's why you need to trust the professionals.
Yeah.
In any aspect of finance or property purchasing, there's a massive financial commitments.
Yeah, correct.
If you're not trusting a professional, it doesn't make sense. And I will bang on to all of my clients. I'm going to pump your tires up a little bit.
Oh, thanks, man.
Of why you would use a buyer's agent.
Yeah.
I had this one client once, right? He wanted to buy an investment property. He builds pools. Amazing. Great at his job. But he goes, you know what? I was looking up, regional Queensland. I reckon it's going to be a really good place to buy. I said, mate, please. I go, you build pools, right? You're not going to go to the bank and get your own loan. The only reason you're not going there is because you're not paying me, right? I'm a free service. The buyer's agent's going to cost you 12 grand, but you can probably make that back in your business building pools if you just spend all the time doing your profession and you pay the professional to do what they want to buy, do what they do.
I would say as well, jumping to what you were saying before as well, it's like you talk about your worst client being the one that comes in and rate shops, right? It's like my worst client is the one that wants the best deal. It's like it's always a bit of a red flag when they're like, oh, I want something that's the best possible deal. It's like everyone wants the best possible deal, right? But if you're buying the cheapest property because it's the cheapest property, there are certain things that are going to be wrong with that property. That's why it's cheap.
How long we got left on this? Because I got a good story about that too.
Yeah, we can.
And I got a story. So a really, really good friend of mine was looking to buy a house, and it was a property, a unit in the inner east suburbs, right? Really nice suburb, super cheap townhouse. I even thought, I'm like, this is crazy cheap.
Yep.
Looked at the Section 32, sent it off to get read by the conveyancer, which again, trust the professionals. Please get your contracts read.
That's someone else I need to have on here.
Get a conveyancer for sure. I mean, it's a massive red flag when someone doesn't read their own contract, right? When someone doesn't send it out to a professional, sends it out to the conveyancer. Right at the bottom of the contract, 126 pages in, there is a cladding report, right? The whole facade of the unit of the development needs to be changed.
Yeah.
It's a $400,000 cost. Report done 2 years ago, no action plan to do it.
Yeah.
I rang around some banks and said, hey, we got this. It's in the contract of sale. How do we deal with this here? Because obviously banks don't want to take on a risk. And they said, unless there's an action plan, forget it. And then most of the banks actually just said, it's got cladding issues, we're not touching it. Doesn't matter how much equity is in there. This was a 60% LVR deal as well. And I didn't even want to touch it.
And that's why, again, it's like we talk about on the first episode again, like there's no such thing as a full approval, right? You could be pre-approved and buy that home. And we haven't even spoken about subject to finance. I'm actually going to jump on after this episode and talk about clauses, right? I might even get you to stay around because we could jump into the finance clause too. But it's like if you go buy that without a subject to finance clause and the bank sees that in the contract because you didn't do the proper due diligence, right? You didn't protect yourself. You're guaranteed that you're going to purchase that property. You've put a deposit to the agent, and if you can't get a bank to go, hey, yeah, I'll secure, a loan against that property for you, you're in big trouble.
Yeah,
big
trouble.
Yeah,
that's why unconditional is always so scary, and the auction culture in Victoria is scary.
Yeah,
right. Always going to auction for things is just crazy because if you go ahead and buy that property with the cladding at auction, you got no recourse.
Yeah,
you're done. Right. You need to. It was your responsibility to get the contract checked out.
Yeah. Well, in every contract, there is a page at the bottom of due diligence.
Actually, in saying that, with the cladding, right? This actually, I'll ask you this question. With the cladding, is that classified a material fact that the agent does the agent need to disclose that if they know
100%.
it?
And that's why
interesting.
That's why it's in the contract. So technically they have to put in a contract. Material facts is another thing, right?
Yeah.
That I was going to chat about after. Actually, no, it was my previous episode I put up today. So the agent has to disclose it and it has to be in the contract. So what they'll do is sometimes they'll bury it in the contract and then the agent
last page of 126.
Yeah, 100%. Yeah, bury it, hide it, font 4. And then the agent will not mention it. And then if anything came to it, they're like, I verbally said it.
Yep.
And it's in the contract. So they've got to written. And it's like, this is what I say to clients. It's like you or anyone listening and in the material facts episode I did, listen to it if you haven't. It's like you need to ask an agent, hey, are there any material facts? But then you need to also put it in writing to them.
Yep.
You need a written record. But if it's not in, by the way, do not take this as legal advice, speak to a professional. But if it's not in the contract, it's a material fact, the agent and the vendor are aware of it, which they would be, by the way, that contract's defective. It's a defective contract.
There you go.
So, we're not advising you to buy property without a subject to finance clause and try and get out of it on a defective contract. Again, seek legal advice. But yeah, to answer your question, that needs to be disclosed and it needs to be disclosed to a buyer upon any interest on buying a property.
I'm adding that to my spiel to my clients.
Yeah.
Subject to finance, subject to a building and pest, and put them in writing.
Yeah.
Is there any material facts in the property that we need to know about in writing?
100%. Yep. Because you can go back to that.
Yep.
And if you send that email and they don't respond, it doesn't matter because they have to respond.
Yep.
They have to have made an effort to indicate that there was a material fact.
100%.
Why don't we end the episode here? But as you said, let's just chat about in the next episode because I'm going to chat about clauses.
Yep.
And it would be good to have you on if we're going to talk about subject to finance, right?
Easy.
Because that's a massive part of it. Thanks everyone for tuning into this episode. I will jump in as well and say if you've listened this far, we really appreciate a review. It massively helps us out and it can also push the podcast to more people to help educate people on how to buy property. In the next episode, we'll jump in and chat about clauses and we'll catch you there.